This pattern is like a powerful spring that can launch your trades to new heights. The price reaches a low point and bounces back, only to come down again and form a second low. But here is the twist. Both lows are around the same level, forming a double bottom shape. Now, pay attention to the neckline, which connects the highs between the two lows. When the price breaks above this neckline, it's like a signal saying, hey, the trend might reverse and head upwards. Double bottom patterns are fantastic opportunities for spotting potential reversals and riding the wave of profits. So, buckle up and join me as we explore the secrets of the double bottom and discover strategies to boost your trading success. Let's dive in. Today, I'm going to reveal the secrets of the double bottom chart pattern and share a powerful strategy to maximize your profits using the 1-hour time frame and the exponential moving average (EMA). The secret to identifying a double bottom lies in recognizing the two lows that form around the same level. This indicates a strong support area where buyers are stepping in to push the price higher. It's like a hidden gem waiting to be discovered. Now, let's talk strategy. Here is how you can leverage the EMA to enhance your double bottom trades on the 1-hour time frame. Wait for the price to break above the neckline and then confirm the bullish momentum by observing the EMA. When the price crosses above the EMA, it's a signal to enter a long trade. Keep in mind that the choice of EMA value can be adjusted based on your trading style and the specific currency pair or asset you are trading. It's important to experiment and find the value that works best for you through backtesting and observation of historical price data. But remember, there are some do's and don'ts to keep in mind. Do ensure that the second bottom is higher than the first. Do use proper risk management techniques, setting stop-loss orders below the pattern. And don't jump into a trade without waiting for confirmation from the EMA and other supporting indicators. By mastering the secrets of the double bottom and implementing the right strategy, you can boost your trading success and unlock profitable opportunities. Stay tuned for more trading tips and strategies. The double top is a bearish reversal pattern that occurs after an extended period of upward price movement. The pattern is characterized by two consecutive peaks that are roughly equal in height, with a moderate decline in price between them. The neckline is drawn connecting the lows of the two peaks. A sell signal is generated when the price breaks below the neckline. The double top pattern is a reliable reversal pattern that can be used to identify potential sell opportunities. Here are some tips for trading the double top pattern. Wait for the price to break below the neckline before entering a short trade. Place your stop-loss order above the neckline. Set your profit target at a distance that is equal to the height of the double top pattern. By following these tips, you can increase your chances of success when trading the double top pattern. The ascending triangle is formed by drawing a horizontal resistance line and an ascending trend line that connects higher lows. This pattern indicates a period of consolidation, with buyers gradually gaining control over the market. To identify an ascending triangle, look for the converging trend lines and the horizontal resistance line. Pay attention to the series of higher lows, indicating increased buying pressure. We're going to dive deep into the fascinating world of the ascending triangle chart pattern. This pattern is a powerful tool that can help us identify potential bullish continuation signals in the market. So, let's get started. The ascending triangle pattern is formed when there is a horizontal resistance line and an ascending trend line that connects higher lows. This pattern indicates a period of consolidation, where buyers gradually gain control over the market. Now, let's discuss how to identify the ascending triangle pattern. The first step is to look for the horizontal resistance line, which is formed by connecting at least two swing highs. This line acts as a strong barrier that prevents the price from moving higher. Next, we draw an ascending trend line by connecting at least two higher lows. This trend line represents the increasing buying pressure as buyers step in at higher prices during the consolidation phase. To confirm the ascending triangle pattern, we need to see the price approaching the horizontal resistance line multiple times, while the higher lows continue to form. This shows that buyers are becoming more aggressive and are pushing the price higher. Once we have identified the ascending triangle pattern, we can start considering potential trading opportunities. The key moment is the breakout above the horizontal resistance line. This breakout indicates that buyers have overwhelmed the sellers and the price is likely to continue its upward move. To trade this pattern, we can wait for the breakout confirmation and enter a long position. It's important to wait for the price to close above the resistance line to ensure a valid breakout. Now, let's discuss some important factors to consider when trading the ascending triangle pattern. First, it's crucial to pay attention to the duration of the pattern. The longer the consolidation phase, the more significant the breakout tends to be. Second, volume plays a crucial role in confirming the breakout. Ideally, we want to see a noticeable increase in volume when the price breaks above the resistance line. This indicates strong buying interest and further supports the bullish bias. Third, it's important to set appropriate stop-loss levels to manage risk. A common approach is to place the stop-loss order below the breakout point or the lower trend line. This helps protect our capital in case the breakout fails and the price reverses. As for profit targets, we can employ different techniques. One approach is to measure the height of the triangle pattern and project it upward from the breakout point. This provides a rough estimate of the potential price target. Another strategy is to use key support and resistance levels as profit targets. Identify significant levels on the chart, such as previous swing highs or Fibonacci retracement levels, and consider closing the trade when the price reaches these levels. Do wait for a clear breakout confirmation before entering a trade. This ensures that the breakout is genuine and increases the likelihood of a successful trade. Patience is key when trading chart patterns. Wait for the breakout confirmation and avoid entering trades based on assumptions or anticipation. This pattern is characterized by a series of lower highs and relatively equal lows, forming a triangle shape that slopes downward. It signals a potential bearish reversal in the market. Identifying the descending triangle is crucial. Look for a strong support level that connects the equal lows, while the upper trend line connects the lower highs. This compression of price action indicates a battle between buyers and sellers, with sellers gradually gaining control. I'm excited to unveil the secrets of the descending triangle chart pattern and share a powerful strategy to make the most of this pattern on the 1-hour time frame. The first secret lies in identifying the descending triangle formation. Look for a series of lower highs and relatively equal lows, creating a downward sloping triangle. This pattern signifies a potential bearish reversal. Now, let's delve into the strategy. Combine the descending triangle with the exponential moving average, EMA, for confirmation. When the price breaks below the support level, wait for the candle to close below the EMA. This validates the bearish momentum and serves as an entry signal for a short trade. As for the do's and don'ts, do set a target profit level based on the pattern's height and implement proper risk management by placing a stop-loss order above the triangle's upper trend line. Don't rush into a trade without confirmation from the EMA and other supporting indicators. Remember, practice patience and discipline in your trading approach. Stay tuned for more trading insights and strategies. This pattern is formed by converging trend lines, creating a triangle shape on the price chart. It indicates a period of indecision and consolidation in the market. The symmetrical triangle pattern suggests that buyers and sellers are in equilibrium, waiting for a decisive move. As the price approaches the apex of the triangle, it signifies increasing tension and the potential for a breakout in either direction. Identifying the symmetrical triangle pattern is relatively straightforward. Look for the converging trend lines that connect the lower highs and higher lows. This pattern provides valuable information about the potential direction of the next significant price move. We're going to unlock the secrets of the symmetrical triangle chart pattern. This pattern is formed when the price creates converging trend lines, resulting in a triangle shape. It's a powerful pattern that often indicates a period of consolidation and indecision in the market. The first secret lies in observing the decreasing price volatility as the triangle narrows. This suggests that a breakout is approaching, and the market is gearing up for a potential big move. Keep a close eye on this narrowing range as it can provide valuable clues for your trading decisions. Now, let's talk strategy. One effective approach is to use the exponential moving average, EMA, on the 1-hour time frame. The EMA with a period of your choice, such as 20, to capture the short-term trend. The strategy involves waiting for a breakout above or below the upper or lower trend line of the triangle. Once the breakout occurs, it's crucial to confirm it with the EMA crossing in the same direction. This convergence acts as an additional confirmation of the breakout and can increase the reliability of your trade. However, it's essential to keep in mind the do's and don'ts when trading the symmetrical triangle pattern. Confirm the breakout with the EMA crossing in the same direction. Set appropriate stop-loss and take profit levels to manage your risk. Consider other supporting indicators, such as volume or momentum, to strengthen your trading decisions. Stay updated on market news and events that may impact your trades. Don't trade without waiting for a confirmed breakout. Patience is key. That's all for today's episode. Stay tuned for more trading tips and strategies. The bullish rectangle is a continuation pattern that indicates a temporary consolidation phase before the resumption of an uptrend. Traders often identify this pattern when the price fluctuates within a horizontal range, forming parallel support and resistance lines. Once the price breaks above the resistance line, it confirms a bullish signal, suggesting the uptrend will likely continue. Understanding the secrets of the bullish rectangle pattern and following these do's and don'ts can help traders navigate the market more effectively. Do identify the pattern by looking for a consolidation phase where the price moves sideways within a defined range with parallel support and resistance lines. Narrator, do wait for a breakout confirmation, which occurs when the price breaks above the resistance line. This validates the bullish signal and suggests a potential uptrend continuation. Narrator, do consider combining the bullish rectangle pattern with other technical indicators like volume analysis or trend lines to strengthen your trading decisions. Don't solely rely on the bullish rectangle pattern. Always consider other factors such as overall market trends, news events, and fundamental analysis before making trading decisions. Don't jump into a trade immediately after identifying the pattern. Wait for the breakout confirmation to avoid false signals and false breakouts. Set stop-loss orders below the support line to protect your position in case of a reversal. The bearish rectangle is a continuation pattern that indicates a temporary consolidation phase before the resumption of a downtrend. Traders often identify this pattern when the price fluctuates within a horizontal range, forming parallel support and resistance lines. Once the price breaks below the support line, it confirms a bearish signal, suggesting the downtrend will likely continue. We will uncover the secrets of the bearish rectangle chart pattern. Let's explore the key insights and considerations for traders. The bearish rectangle pattern signifies a temporary consolidation phase before a potential continuation of the downtrend. It suggests that sellers have been exerting pressure, leading to a pause in the downward movement. Traders identify this pattern by observing a horizontal range formed by parallel support and resistance lines. The price tends to oscillate within this range, indicating a lack of strong buying interest. The bearish signal is confirmed when the price breaks below the support line of the rectangle pattern. This breakdown suggests a potential resumption of the downtrend and a further decline in prices. Volume analysis plays a crucial role in validating the bearish signal. Increasing or above average selling volume during the breakdown strengthens the bearish sentiment and indicates a higher probability of price decline. Traders should consider placing stop-loss orders above the resistance line to protect against potential false breakouts. These tips will help you navigate this pattern and improve your trading decisions. Do identify the bearish rectangle pattern by looking for a clear consolidation phase with parallel support and resistance lines. Do wait for the breakdown confirmation, which occurs when the price breaks below the support line. This validates the bearish signal and suggests a higher likelihood of further price decline. Do consider combining the bearish rectangle pattern with volume analysis. Look for increasing or above average selling volume during the breakdown, as it strengthens the bearish sentiment. Do practice proper risk management. Set stop-loss orders above the resistance line to protect your position in case of false breakouts or unexpected price reversals. Don't rush into a trade immediately after identifying the pattern. Wait for the breakdown confirmation and ensure the signal aligns with other supporting factors. Don't neglect the importance of volume analysis. Volume provides insights into market participation and can help validate the bearish signal. Don't forget to adjust your stop-loss and profit target levels as the trade progresses. Consider trailing the stop-loss to protect profits as the price continues to decline. Now, before we conclude, we kindly request your support. If you found this segment helpful and informative, please take a moment to hit the like button and share it with others. Your engagement helps us reach more viewers and bring valuable content to a wider audience. Don't forget to subscribe to our channel to stay updated with future market analysis and trading strategies. Thank you for your support. The rising wedge is a bearish continuation pattern characterized by converging trend lines where the lower trend line slopes up at a steeper angle than the upper trend line. Traders identify this pattern as a sign of a potential price reversal, indicating a weakening bullish momentum. Once the price breaks below the lower trend line, it confirms a bearish signal, suggesting an upcoming price decline. Understanding this pattern can empower traders to make informed decisions and navigate potential market reversals effectively. The rising wedge pattern is a bearish continuation pattern characterized by converging trend lines. The lower trend line has a steeper slope than the upper trend line, creating a wedge-like shape. The pattern suggests a weakening bullish momentum and a potential upcoming price reversal. It signifies a struggle between buyers and sellers, with sellers gaining control over time. Volume analysis is crucial when trading the rising wedge pattern. Look for decreasing volume as a pattern forms, indicating diminishing buying pressure and potential exhaustion. The breakout direction provides a significant clue for future price movement. While the pattern is bearish, A decisive breakout below the lower trend line confirms the bearish signal and increases the probability of a price decline. Do wait for a confirmed breakout below the lower trend line before taking a bearish position. Patience is essential to avoid false signals and ensure a higher probability of success. Do consider using additional technical indicators or tools to confirm the bearish signal. Supportive indicators like bearish divergence, overbought conditions, or negative news can strengthen the validity of the pattern. Do set your stop-loss orders above the upper trend line to manage risk. This helps protect your position in case of a false breakout or unexpected price reversal. Do keep an eye on volume during the breakout. Increasing volume during the breakdown validates the bearish sentiment and suggests stronger selling pressure. Don't jump into a trade solely based on the formation of the rising wedge pattern. Wait for a confirmed breakout and consider the overall market conditions, news events, and fundamental analysis. Don't ignore the importance of risk management. Set realistic profit targets and adjust your stop-loss levels as the trade progresses to protect your capital. Don't chase the market or try to predict the exact timing of the breakout. Allow the price action to confirm the pattern and respect your predefined entry criteria. The falling wedge is a bullish continuation pattern characterized by converging trend lines, where the upper trend line slopes down at a steeper angle than the lower trend line. Traders identify this pattern as a sign of a potential price reversal, indicating a weakening bearish momentum. Once the price breaks above the upper trend line, it confirms a bullish signal, suggesting an upcoming price increase. Remember, the falling wedge pattern can provide valuable insights for traders looking to profit from potential market upswings. We're going to dive deep into the secrets, do's, and don'ts of the falling wedge chart pattern. If you found this video helpful, don't forget to hit the like button and subscribe to our channel for more valuable content like this. The falling wedge pattern is characterized by converging trend lines, with the upper trend line having a steeper slope than the lower trend line. This pattern suggests a weakening bearish momentum and signals a potential price reversal. One of the secrets of the falling wedge pattern lies in volume analysis. As the pattern forms, pay attention to decreasing volume, indicating diminishing selling pressure and potential exhaustion among sellers. This is a sign that buyers might be gaining control. Decisive breakout above the upper trend line confirms the bullish signal. This breakout triggers a potential price increase, as it suggests an increase in buying pressure and a higher probability of a bullish movement. Wait for a confirmed breakout above the upper trend line before entering a bullish position. Patience is key to avoid false signals and increase the probability of success. Consider using additional technical indicators or tools to confirm the bullish signal. Look for supportive indicators like bullish divergence, oversold conditions, or positive news to strengthen the validity of the pattern. Manage your risk by setting stop-loss orders below the lower trend line. This helps protect your position in case of a false breakout or unexpected price reversal. Don't forget to keep an eye on volume during the breakout. Increasing volume during the breakout confirms the bullish sentiment and suggests stronger buying pressure. Don't jump into a trade solely based on the formation of the pattern. Wait for a confirmed breakout and consider other factors like market conditions, news events, and fundamental analysis. Don't neglect risk management. Set realistic profit targets and adjust stop-loss levels as the trade progresses to protect your capital.